was flipping houses. We were doing stuff. We were buying houses, and then we sold them off to Invitation Homes in bulks, sales. And I was really good at being the contractor, and I was micro correct. So I could save you, 10 cents a linear foot on baseboard, 25 cents a square foot on paint. I was good, and I was able to squeeze those kind of margins. When they came into the market and were buying hundreds or thousands of houses at a time, and the reason I say this kind of relates to commercial is because it was really now moving it up into a portfolio type mentality. And so they were macro correct, and they made $8 billion, and they were really paying over market value, today's market value. So if a house was worth $300,000 or an asset or one unit was worth $300,000 during that time period, and they came in and paid $350,000, you and me, if we're existing in that market and we're playing on today's pricing, we're like, that's stupid. Like, what are they doing? They're overpaying. And so then I looked at that and I pulled that back, figured out some of the things that they were doing. They were playing off the previous peak price. And they said, hey, we'll be willing to pay up to 75% of previous peak price. So we think the previous peak price was $500,000. So we'll pay up to that price because we think it's going to shoulder off that price and go above that $500,000 in, the longer game. So they're playing a 10-year horizon. You and I were playing a game of 6 months or a year. And I go, so they're playing a different game. And so where you go try to outbeat them by playing a different game, it's a losing strategy. So what I did was started to take and break down, what were they doing? And how did they systematize this? How did they create, you hear the word, the buy box. How did they create a criteria for what they were buying?